To scale or not to scale out your trading profits? Now that's a question. Now the answer depends on you and what your priority in trading is. In my swing trading of the currency markets, many times I take some profits off the table and I keep them safe in the confines of the trading account. And the reason I do it, it's not only a psychological one, but a risk control measure as well. Humans love to be right. In trading, the market's always right, and I totally accept that at any time. Price can turn against me and take back the unclaimed profits that were sitting there. By taking a piece out of the market and banking some profits, I feel good. Not only do I feel good, but it allows me to handle any retrace in unclaimed profits in a more relaxed manner. After all, I'm not a robot that can enter and exit the markets without a hint of emotion. If I see a full position giving back some of the profits, it bugs me. Now, banking some profits at certain areas of the chart, whether it's a structure or other defined price target, it really simmers down the irritation of giving back to the markets. Now, this chart is an example. It's not a real trade example, though, of how I would have scaled out of this trade. Number one, after shorting at the break of a range, this is an obvious price rejection zone for a scale out. Demand came into the market at this zone, and you can see when price ventured into the region, it was held up before finally breaking to the downside. Number two, this was the pivot area where price began the upside corrective move. You can see an obvious bull candle, and while prices were held up, it did slam through. And number three, it's the final target area, which is a 127% extension of the corrective move. And I look at my trading account as business capital. Like many businesses, we never really know if the next investment in just about anything will pay off. Yeah, we look at probabilities, much like any business does on the ROI, but that's about the extent of our control. Either we get involved or we don't. Now, we can't control if the next trade that we plunk our capital down on will pay off. I accept that the unknown variables are truly unknown, and even though my plan says take the trade, whether it works out depends on other factors. The markets are uncertain, and scaling out lessens exposure for the unexpected. I can control entering the position. I can also control my risk. And for me, the priority is not to avoid loss, is that surprising? But it's to limit the impact of any loss. I know I am going to lose trades, and controlling risk, for me, is really the utmost importance. Now, when scaling out, you don't really even have to move your stop to lessen the impact of a loss. Let's look at a simple example using the currency markets. One standard lot buying in with a 20 pip stop loss. Maximum loss is 200. So we're going to call it the R, the risk. If you scale out a portion of 3 at plus 20 pips and bank 60, that leaves you with 7 mini lots in the market. If price takes you out, the loss is $140, which is minus 0.7 R. And that's if you don't move your stop. Let's keep this going. Scale out a portion of 3 at plus 40 and it banks $120. Then move your stop to break even after banking 180. Regardless of what happens now, you've taken profit, you've been paid on this trade. You then have 4 minis still riding in the market where you can now trail the stop under the market structure. See, our goal is not really to reach targets, but to make money. As well, you now have free capital to use to get back into the market if the conditions are present. And another thing that really doesn't matter to the average retail trader in Forex is slippage. But let's cover that quickly. If you're in a long position and you scale out with price going up, what's the chance of slippage? Well, next to none in the case of negative slippage. Keep in mind that the average FX trader doesn't trade the actual market. Their broker is the one that fills the trades, and they offset their risk on another tier. So is this the optimal way of banking profits? I don't know. However, many simulations show that staying with full position sizing throughout the trade is more profitable. I do know that the answer to this still evades me. Some trades I do not scale out while others I do, and it's a weakness that I have in my own trading, which is I don't have that set in stone. I actually go more by gut feel, which is not always the most optimal way to make a decision. Now, the scale topic becomes the heated debate in some forums, with each side taking the extreme view that their way is the best. And for me, I just ignore the quote-unquote experts. I accept that I may not be doing the optimal thing right now and that there are areas of improvement for me. The truth is that I scale not because it may or may not have a positive impact on my overall results. I do it because it takes the stress out of having a position on in the market. And at the end of the day, being in the right frame of mind before, during, and after trade is the most important thing for me. Being in the wrong state of mind when trading can have a detrimental effect to your performance. Now, removing risk, for me, is just one way to keep the psychological dogs at bay and help keep me from making mistakes I know go against the path of the road to being consistent.